Hi, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, another good day for stocks, and JBWere's Tom Goode will tell us how long can we exploit this buying opportunity. Arminius Capital's Marcel von Pfeiffer will evaluate the dangers lurking on Wall Street with the S&P 500 breaching the 200-day moving average. Will US earnings bring back the optimists? Our currency expert Joe Masters will check the pulse of the Aussie dollar. Could it really be on the way up, or should we look to 85 US cents? Professor Elizabeth Sheedy ranks the culture of our banks. So how do they rate compared to their pommy rivals? And with bad news being forced upon us by an overwhelming media, Deloitte's Keith Skinner tells us how optimistic or pessimistic the country's #1 bean counters are. Then, of course, the CFOs of our biggest companies. Stay with us for the next hour. We'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to switzer@switzer.com.au. And you can follow me on Twitter, and the handle is @PeterSwitzer. Okay, we've had 2 good days on the stock market, but can they keep on coming? Let's put the pressure on Tom Goode from JBWere. He joins us from our Melbourne studio. Hi, Tom.
Hi, Peter. How are you?
I always like to give you an easy question. What do you reckon?
3 days in a row would be pretty good to see.
Huge.
Who knows? Who knows is the answer whether it happens again tomorrow. I mean, we've definitely seen, I think, a little bit of value buying come through to our market. So both in resources, which got clearly beaten up in the last couple of weeks, and we've seen a bounce there in the last couple of days. China's inflation number came through at 1.6%, which is far below what they're looking for. So there is that chance that you get some further stimulus from China over the next little while, and that would certainly boost the commodities short term. And then if you look across the rest of the market, well, essentially it's 10% cheaper than it was a couple of weeks ago. And we're starting to see the buying come in. Both, I think you're getting some yield support, but also just that sense that things are basically cheaper across the board. So in the short term, though, it really depends, I think, on what happens in the US. And the troubling thing there is that we are breaching a few technical levels. And what you're seeing in the US market is that late in each session, it really is falling away quite rapidly. So last night, for example, the Dow was up 140 points at one stage and finished the day essentially flat. So no one's really stepping up there at the moment in front of the force of the market as it starts to pull back a little bit, and with that uncertainty around rates and the Fed possibly turning off the tap in October, there's a few things working against us as well.
Okay, Tom, tell us what's wrong with this great analysis. All right, so we've fallen, value buyers come in, encouraged by P. Switzer, that was a buying opportunity. But then the Yanks get a little bit more negative and down goes Wall Street. Do we play follow the leader and go down with them for a while and maybe create another buying opportunity?
Well, for the most part, we do. It's very rare that if the US is falling away quite rapidly, that we'd be going up. So I would be surprised if that happens, and that's the nature of, I guess, short-term markets versus the sort of long-term fundamentals. And I think that ultimately, yes, we are in for a period of greater volatility, as the RBA was alluding to yesterday, and that adjustment as the US goes through sort of essentially weaning itself off of cheap money and back onto a slow progression towards a normal interest rate cycle. So I think we are in for more volatility. I don't think that there's a catalyst short term for the market to go roaring away, but now's the time to start picking away carefully at value, and I think essentially what you do is you just chip away into the market rather than ploughing it all in on day one.
Yeah, good advice. Let's look at some companies. Rio Tinto, what's the story there?
They had their quarterly production result out today. It was a pretty solid number, particularly led by iron ore, and essentially it is an iron ore business these days. So it was good to see that tracking well. Their production of iron ore was ahead of our estimates. They're tracking for about 290 million tonnes of iron ore production for the year. And more importantly, they said they're about 3/4 of the way through building the infrastructure that will provide the expansion of that to grow to 360 million tonnes next year. So that was good. Copper production was also good. good. Coal was a little bit mixed. Thermal coal was strong, metallurgical coal was down, but all in all a fairly solid result. At the end of the day, the key for Rio is going to be, can they deliver on that expansion, a significant increase in the production of iron ore, and obviously also the iron ore price. They really are an iron ore play these days. But if they can get the production out, a lot of cash flow comes in the door. They're still the best iron ore producer in the world, essentially, and that bodes well for cash coming back to shareholders.
Tom, what does your research team say about iron ore prices going into the better quarter of the year for iron ore prices?
Well, our research team were calling for iron ore to fall to around $80 sort of late this year. So they've called that really well. They're not expecting any significant recovery short term. So the expectation is that, in a nutshell, you've got a huge amount more supply coming onto markets over the next year. Demand is increasing, but not at the extent that supply is increasing. So you're going to have this sort of 150 million odd tonne oversupply of iron ore next year. So that's very much an issue for the price, and you would think that keeps a lid on it. And then in the short term, it probably depends whether China comes out with some more stimulus. If they get the sense that they've done enough to slow the economy down there, that inflation is very, very low, and that they're concerned that things could slow down below a growth level that they're comfortable with, you may see some stimulus, and that could boost things short term. But if there was any sort of significant short term iron ore bounce in iron ore, I'd have the sense that is a short term phenomenon rather than something that's sustainable.
Okay, Dick Smith, a positive trading update.
Yeah, they did have a good number. 10% growth in revenues. That's 1.7% when you look at like-for-like sales. So a positive number in a really tough market. I mean, if you look at the Reject Shop, for example, that also came out today, they were down 5%. So competition's tough. And Dick Smith are pulling out positive numbers, which is a testament to the strategy and the growth strategy that they're implementing. They're looking at rolling out more and more stores. So all signs positive at this stage for them. But the key for a lot of these retailers is really this next quarter, as opposed to the last 15 weeks, which is what they were updating on today, and the Christmas trading period. So that's critical for them. But all in all, some signs of growth in a stock that's on a 6% fully franked yield, trading at about 10 times earnings. So the market's certainly not paying up for them at the moment, and they do look like one of the retailers that's actually delivering some results.
And they must be taking market share of the likes of JBWere.
You would think so. You can't sort of keep expanding. I mean, the market is pretty saturated at the moment. I know they're doing well with their stores that are in, for example, David Jones and that strategy as well. But you'd think that they are picking up a bit of share, and it's not something where all the retailers are going to do well. I think they're a standout in a bunch that are under a lot of pressure at the moment.
We had Tom Goode on the program a few months ago, and he's pretty impressive. Okay, yep. Tabcorp.
Tabcorp also had a quarterly trading update. It was a pretty strong result. The stock was up 4% today. Most of that came through wagering. So revenues were up 6.6%, wagering up 8% on last year, which is a very strong result. Although if you dig through the details, a lot of that was to do with the World Cup, so that fell in this more recent quarter. So expectations would be that you actually start to see those numbers peter off, close to lower single-digit sort of type revenue growth as the year goes on. The stock's trading on 17.5 times, certainly looking pretty fully priced at the moment. So I'd suggest that there's probably better value out there in the market at the moment, particularly if you're looking for yield.
But Tom, you do come from Melbourne. Isn't the November, well, we call it the December quarter, isn't that going to be good for Tabcorp with all you maniacs betting on the Melbourne Cup?
It is good. I think it's more in terms of if you're comparing things on a previous corresponding period type analysis. So that's an every year event. The World Cup was sort of a once in a 4-year event, and it tends to skew the numbers a little bit. So I think if you're cycling off last year's spring racing carnival with this year, it's going to be much of a muchness.
Okay, so just before we finish up, do you like Rio Tinto at these prices?
I think it's still very much a trade, Rio, as opposed to a sort of a core holding. So I'd still stick with BHP at the quality end and locking in a pretty solid yield and some diversified earnings. For Rio, well, as I said, it's very much a trade. I mean, it's a volatile stock. It's had a pretty good bounce. If you're looking to play iron ore, I would play it through Rio because it is still at the quality end. So you get the leverage if iron ore bounces, but you don't take on the risk, I guess, of some of those more marginal producers. But as I was saying before, I really don't think any bounce in iron ore is sustainable beyond a couple of weeks or a month. So I wouldn't be sort of chasing it with my ears pinned back in the $60+ range.
And you seem keen on Dick Smith. Did I misinterpret you?
No, we like Dick Smith. I mean, it's a tough sector, as I was saying, but I think that it's a stock that screens pretty cheap. I don't think people are quite paying up for the management story yet. I mean, most people look at retail and really struggle to see where the growth's going to come from. But this is a business that's had a good cost-out strategy. They are rolling out new stores and they are delivering on growth. So I think in a tough sector, yes, I think Dick Smith looks pretty good.
Pretty good from Tom Goode. Thanks, mate.
Thanks, Peter.
See you, mate. After break, Wall Street went barely positive overnight, so what lies ahead? Marcel von Pfeiffer next on this important topic.